WeWork wasn't the first co-working company when it was founded in 2010 by Adam Neumann and Miguel McKelvey, but it has quickly become one of the biggest. With 528 locations in 111 cities across 29 countries, WeWork is a global success. In the past decade, the company has added over 500,000 members, gobbled up 45 million square feet globally, and is now the largest office space tenant in Manhattan. The company has been valued as high as $47 billion, but many are questioning its worth. So how does WeWork make its money? WeWork is a landlord. It leases office space, parcels it up, and sublets it out at a higher price through its membership system. From the beginning, WeWork's customer base has been startups, freelancers, entrepreneurs, and small businesses. Individuals can rent a desk or private office, and businesses can rent out suites or even entire floors. WeWork's closest competitor is IWG, which uses a similar rental arbitrage model. It's turning a profit, but it's only valued at $3.7 billion, whereas WeWork isn't yet profitable and had a valuation more than 10 times that. So what makes WeWork stand out? Since the beginning, WeWork has thought about branding and aesthetic. Its signature look is instantly recognizable. Industrial, clean, open space with a lot of wood and bright lights. You know the look. It's that millennial aesthetic, the one that does well on Instagram. And that style has set WeWork apart from competitors, though some have started to follow suit.
But because WeWork was a first mover in this space, it retains some sort of brand recognition, both among its members and among kind of the general working public. People know a WeWork in a different way than they know some of its competitors.
WeWork has also tried to become more than just a place people work. It wants to be your way of life. In January 2019, WeWork changed its name to the We Company to move beyond co-working. The We Company opened co-living spaces in New York City and Washington, D.C., a school, and a gym.
Neumann would like the company to be an all-encompassing ecosystem where someone could work out at a We-branded gym in the morning, go to a WeWork office, send their kids to a WeGrow elementary school, and then go home to their WeLive apartment.
And while WeWork's main function is real estate, it's been justifying its massive valuation by calling itself a tech company. In its IPO filing, WeWork says its extensive technology infrastructure is crucial to its business. And thanks to its massive scale, WeWork has a lot of data that it's banking on to increase revenue. For example, WeWork knows a lot about how people work, like when they're most productive and how much space they need and when. But not everyone is convinced that WeWork is a tech company.
In the end, I think most investors will look at them as a real estate play with some really good technology incorporated into what is a real estate company at the end of the day.
WeWork's lofty goals and aggressive expansion don't come cheap. The company is burning cash. Though WeWork made $1.8 billion in revenue in 2018, it also lost $1.9 billion. It lost $219,000 every hour for a year, leading up to March 2019. But bleeding money didn't stop Japanese conglomerate SoftBank from pouring cash into the company. SoftBank has invested more than $10 billion in WeWork, giving it a valuation of $47 billion in January 2019. But not everyone is convinced that WeWork is worth that much. Since releasing its IPO paperwork in August, WeWork's valuation has taken a hit. The company reportedly considered a valuation of $10 billion to $12 billion, only about a quarter of its peak valuation. WeWork delayed the IPO. Part of it has to do with the fact that investors are worried about what would happen to WeWork during a recession. WeWork's customer base would be at risk, like what happened to IWG in the early 2000s, when the company's US arm had to file for bankruptcy. During the recession, companies struggled and moved out of the office spaces, so IWG was stuck shouldering the rent. And as a result, its US business was losing as much as $4.1 million a month. WeWork has been trying to safeguard itself by courting Fortune 500 companies. Enterprise customers tend to rent out spaces for longer and can be more stable than startups. WeWork's efforts have worked. Employees of blue-chip companies now make up more than 40% of WeWork's members. WeWork also runs Powered by We, which lets companies outsource office design and maintenance. Amazon, Airbnb, IBM, and UBS all have WeWork-run offices. And even if there were a recession, CEO Adam Neumann says that WeWork could benefit, saying that short-term leases could look more attractive to penny-pinching customers, and a downturn could get WeWork better deals on leases. But like WeWork's valuation, Neumann's role as CEO has also come under scrutiny. Investors are worried about the amount of control he has in the We Company, and some of his actions, like leasing buildings he owns to WeWork, have raised eyebrows. Though WeWork made changes to the corporate structure that loosened Neumann's grip, they might not be enough. WeWork desperately needs to raise more money to continue expanding at its current pace. And delaying the IPO could mean more time for the company to convince investors to get on board.
It's an important benchmark to see if investors do buy into this concept, and then we'll show how future IPOs could perform as well. It's an important benchmark as well for investors in similar companies so they can see how their valuations might stack up against a publicly traded company.